Hey everyone, it's Imran from Options Insight with your macro options spotlight.
Remember, like, subscribe, comment, ask questions.
Okay, so back from a long weekend. US markets were obviously shut yesterday, but they did close up on Friday into the long weekend as we're getting more and more Goldilocks type data with inflation cooling and growth holding up. And we've got what is probably a recession consensus in terms of positioning, and that creates a bit of an upside pain trade. So some of the strategists on the street are calling for the pain trade to be higher, even though ultimately we may end up going into recession, but a bit later than anticipated. We could get a short-term 1 to 3 month period where this market wants to rip higher and really go after the shorts, basically, right? And we saw a few of those periods last year, so no reason to believe that that's not possible. And we're already starting to see quite a lot of action in crypto markets with shorts getting liquidated over the weekend. Now, there was little follow through in Europe yesterday on the rally. Europe was obviously open, but small up across the board there, like 20, 30 bips. But then Japan was down about 1%, and Japan getting a little bit nervous ahead of the Bank of Japan, which is on Wednesday this week. It's a strong week for commodities. So you saw some decent performances again from gold, up 3%. We saw oil up 8%, and we saw copper up another 8% last week. So broad-based rallies in commodities. Really loving this kind of China reopen narrative. Not natural gas, on the other hand, is still suffering, down 7% last week, where European nat gas continues to come down, and warmer weather in general, and full supplies and storage tanks of gas mean that there's no pressure right now in that market to go higher. Looking at vols, breaking aggressively lower as earnings kind of steal the focus. VIX really attacking that 18 level that has been a support level all of last year. We suspect there may well be a break to the downside of that. We've got VIX expiry this week. Often you get a bit of a move on VIX expiry. That might be the catalyst to trigger this break in VIX. We'll see. But in general, with earnings focus, if the indices are kind of stuck and can't really go anywhere, and we kind of get stock dispersion where stocks go up and down depending on how they are versus earnings, then we may well see those indices break down in terms of vol. In terms of commodity vols, we did see commodity vols sliding as well, particularly the high vol names such as oil, GDX, which is the gold miners, and uranium. And then in terms of carry, we've got some small negative carry still in US stocks, as implied kind of price in a calmer index landscape going forward. So we do expect those realized vols probably to continue to come down as well, doing basically what the implieds are already pricing in. FTSE realizes on a single digit, mid-single digits, which is pretty dramatic, right? It's just the lowest vol out there already at 11 vol, and it's realizing 6. So there's that argument again that low vol doesn't equal cheap vol. In fact, you could argue the most expensive vol on the whole board right now is FTSE at 11.7 because it's realizing 6. And then lastly, on this point, you've got negative carry in oil. Realized they're about 43. Implieds have got hit quite hard. They're down 5 vols last week, down to 37. And that might present a bit of an opportunity, as oil vols do seem to be overshooting, because we've got OPEC. We've got an OPEC report out this week where they're going to talk about the demand outlook, and that might trigger a bit more movement. We're also starting to see a bit of momentum gathering in oil. So just something to watch out for there. But I think that vol starting to look interesting to pick up that vol again in the mid-30s. Okay, so if we move on, we've got bullish developments. So here, we're just going to talk about a few things that we've seen that have kind of made markets go a bit more bullish and kind of made the short-term outlook a bit less gloomy. So obviously, we've got large bank earnings due today, Morgan Stanley and Goldman's. Those two do tend to do well in their trading businesses when markets are volatile, as they were in Q4, especially fixed income and commodities. So we'd expect them to do all right in terms of trading revenues. But if we look at what the bank stocks did last week, they reported results. They were down initially. Loan loss reserves were increased, but they were rewarded for cost cutting. So you did see them rally back and finish the day up. So this soft landing narrative is starting to gain traction as well. So that might play well for bank stocks, and just the price action that we saw late last week on those stocks bodes well in general for the sector. The sector's had a decent run already, but we think it might have some legs to go a bit higher if this soft landing narrative kind of continues to build. Looking at China, economic data did beat low expectations. We had industrial output, retail sales, GDP all beating forecasts. Policymakers have kind of clearly said that growth is a priority this year. And whilst they remove COVID zero and that's hurt short-term activity, there are already signs of peaking cases that suggest that these targets of above 5% growth this year could be quite achievable. Now, the risks to growth are obviously things like poor external demand from the likes of Europe and the US as they go into recessions. And you do have a shrinking population, obviously, in China, so demographics are not favorable. But, you know, markets are probably going to give the benefit of the doubt in Q1, as we already started to see in China reopening plays, particularly the stock market, as investors are in search for value, right? They've got a lot of dry powder. They want to put money to work. They're putting that money to work in places where they think there's value, like the Chinese stock market. And then another major development for risk assets last week was this thing about Janet Yellen planning to drain the TGA to be able to finance extraordinary measures whilst we wait for the debt ceiling resolution. Okay, so debt ceiling's up to be, you know, raised. There's always a big political hoo-ha about it, and they're never going to agree it straight away, and it's going to go on and be a theatre into maybe September, October this year. Now, the people who understand all these dynamics in great detail are basically saying that if they do drain the TGA down as is anticipated, this is going to completely negate the impact of QT that the Fed is doing. And that's going to make it hard for the Fed to keep a lid on risk assets, and therefore you're going to see a potential loosening in financial conditions. So at the margin, this news is bullish in the short term because the impact of QT that should be weighing on risk assets isn't going to be felt if the Treasury General account gets drained the way we're hearing that it is going to. And this may well be a large part why the crypto market has taken off in the last week, because it tracks net liquidity. So if net liquidity expectations are going back higher because of the dynamics between the TGA and what is expected to happen over coming months, then, you know, that net liquidity line goes higher. That takes risk assets with it. We know the S&P tracks it, and we know that Bitcoin tracks it as well. So Bitcoin's had a big move over the weekend. It's rallied like 20% in a week. And maybe that is that market really reacting to this news about what net liquidity is going to do. Okay, in terms of the big macro focus for this week, it's by far and away Bank of Japan. So Bank of Japan have got their meeting on Wednesday. And we did start to see 10-year yields last week. We mentioned it in our dailies, breaking 50 bips. Markets got spooked that another policy shift is coming. And the event vol premium has really been priced in. So if we look at overnight vols in Japan, we've got them up to 50%. So it's implying like close to a 3% move on the day. Okay. And, you know, we know Japan matters for macro because they're a big exporter of capital to the world. So major changes in that policy and what Japanese investors do will impact global markets in terms of the dollar and in rates. And that will in turn impact other asset classes. So something we need to be cognizant of. Skew is obviously widened back to the 99th percentile. Overnight vols are super high, multi-year highs, suggesting a move, like I said, around 3%. Japanese inflation is obviously accelerating. PPIs at 10, CPIs at 4. So they have got pressure on them, but it's unclear whether or not they're going to remove YCC, just lift it another 25 basis points. No one really knows what they're going to do, but the market is anticipating quite a bit of volatility on Wednesday. So something you need to be aware of, because it's not, whereas without the Bank of Japan being such a, you know, key meeting this time around, it would have been all the focus on micro and earnings. Not really going to be the case this week, because this is quite a big deal. All right, moving on to other things, delve a bit deeper into equities. Apart from overbought signals, volatility's got hit pretty hard as well. So rather than bearish risk reversals, we're seeing buy put screen up there on everything. In terms of this week, we've got the expiry, obviously, OPEX, Jan OPEX. 4,000 seems to be the big dominant strike where all the gamma is. And we do think, by the way, implied's got absolutely crushed. That's a confirmation that the street is quite long. So we wouldn't be surprised if the market got a bit sticky and sat around this 4,000 level. For us to really get some volatility back in the S&P, we would need to break below the kind of volatility trigger, which is below 39.50, for us to really get moving. I think it's more likely that the overbought conditions get kind of worked off via some consolidation around this area where we go unchanged for a week or two as all the focus is on earnings, and then maybe the market can go again, basically. So I favor that as opposed to a big breakdown. Now, in terms of trade idea that I would kind of use to play that viewpoint, and that pretty much rounds off the daily note. And I'll catch you guys tomorrow.